Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We're here live every Wednesday, and of course, we will repeat this program throughout the week. If you have questions about your portfolio, if you're concerned about the advice you're getting, or maybe the lack of advice you're getting, if maybe you were sold investment products through a Wall Street firm or a so-called advisor that aren't appropriate for your portfolio, or maybe you just don't have the right strategy and you lost money in 2013, call me in the studio. We'll take your calls about stocks, bonds, mutual funds. Maybe somebody sold you a bunch of annuities that turned out to be real garbage. Call us. We'll set you straight. We'll give you the right answers for any of your investment questions. Remember, we're here every Wednesday. Please go to my website. You can also send me questions to brianresny@reznywealth.com. And again, all those questions will be answered on the TV show. You know, I want to start off a little bit today and talk about the improving economy, not only here in the U.S., but also around the world. Europe's getting a little better. The emerging market economies are getting a little better. Guess what, folks? There's a lot of Debbie Downers, as we call them out there, who listen to pessimistic news on a lot of these TV shows. At the end of the day, the economies around the world are starting to improve. In fact, if you look at unemployment in this country, it's getting better. People who want to work generally can find jobs. I see good GDP growth as we get into 2014, and more importantly, investors who follow a strict investment strategy like we do around relative strength investing, we feel have a great opportunity not only to reduce risk in the portfolio, but have potential to grow not only the portfolio size, but to also get additional income from that portfolio. Jim and Sue from Fort Myers, Florida, we attended one of your workshops and learned a lot. We used your fiduciary versus suitability questionnaire with our current advisor, only to find out he is not a fiduciary. We are scheduled to see you next. Please explain to your listeners the difference. It's important. Jim and Sue, thank you for the nice comments. A lot of investors, unfortunately, falsely believe that all investment firms act in a fiduciary capacity. And simply, that is not the case. In fact, about 90% of the individuals like you who come into our offices in Naples or in Fort Myers to talk to us about managing their wealth without the conflicts of these so-called advisors in Wall Street never realized that most firms really are working what's called under suitability versus fiduciary, meaning not only do they not manage your money, they can sell you products that are downright lousy and expensive and not good, and suitability's been met. One of your biggest single risks as an investor is to falsely believe all investment firms and advisors have a legal obligation to work in your best interest as a fiduciary. That is simply not the case. And again, we have a lot of clients throughout the state of Florida and around the country, and most individuals, because again, Wall Street doesn't want to educate you the difference between suitability and fiduciary. Today, I'll talk a little bit about that. The fiduciary standard of care is pretty simple. It means legally, we have to work in the best interest of our clients, always putting our clients ahead of our firm or our advisors. Suitability means that the advisor only needs to suggest products that are suitable for your objectives and your income and age level. And suitability's been met. Simply put, let's say you are 65 and you want to grow some of your money. So you're a moderate growth investor. Most of these brokerage firms or so-called advisors can sell you an expensive, mediocre mutual fund because it's a growth mutual fund and it meets your objectives. It doesn't have to be a good performer. It can be really expensive, and suitability's been met. Put it a different way, suitability. You go to the grocery store to buy a loaf of bread. There's a moldy loaf of $3 bread on the counter. Right next to it is a brand new wholesome loaf of bread for $1.50 just off the bread truck. Fiduciary standard of care would be the less expensive, better quality loaf of bread. Suitability is you're suitable to buy white bread. It doesn't have to be the best or the cheapest. And again, suitability's been met. The majority, in fact, about 90% of investors that come to our offices again are working with advisors they falsely believe are managing their money and falsely believe that they're a fee-only firm and that they have a legal obligation as a fiduciary. Simply put, most of these advisors are using fancy titles to disguise that they're really acting as a broker and selling you investments They might call you with the warm and fuzzy quarterly phone call, but that's not investment management. If you're in a brokerage account, if you're paying a fee in lieu of commission, if you're paying commission, you are probably in what's called a suitability or a brokerage account. And again, expenses, conflicts, and your best interest are not being served when you have a brokerage account. Muhammad in Fort Myers, Florida. I want to know about the John Hancock Growth Fund Leader B, symbol USLBX. Should I buy it or not? Muhammad, do not buy this fund. First off, it's a B share class mutual fund. Clearly, the person that is showing you this fund is a broker. Never ever buy C class or B class share mutual funds. In fact, listeners, after our show today, pull out your brokerage statements. If you see any C class or B class share mutual funds, your money's being taken to the woodshed. B and C class share mutual funds are the most expensive of all classes of mutual funds. They're better for the broker and his or her firm than for your account. Your obligation is to your money and to earn a return, a competitive rate of return, and reduce expenses. When you're working with a broker, like the one Muhammad you are clearly working with, he's trying to sell you a B class share mutual fund because he makes more commission and you make a lot less. That particular fund not only has underperformed the S&P over the last 3 years, it has an expense ratio close to 2% a year. Instead of looking at that fund, look at something like the iShares IVV. It tracks the S&P 500. It has outperformed that fund, and the annual expense ratio is less than 15 basis points a year. Much better for you. That's the fiduciary answer. What you're getting is the sales job, the suitability from your broker. I'd also encourage you, Muhammad, call our office for a consultation. We do have an office in Naples and in Fort Myers. Let us sit down with you. We can talk about how we actually manage money, how we can better suit your needs, and help you get to where you want to go in a more concise manner. Sam in Naples, Florida. I have a portfolio, $2.5 million, mostly comprising 15 closed-end mutual funds for income. I was down 12% in 2013, and I am not sure what to do now. Sam, what it sounds like is you were buying closed-end mutual funds, which are different than open-end mutual funds. Closed-end mutual funds and all mutual funds can go up or down. What you're doing is you're chasing yield. You're buying these closed-end funds, which often have leverage, meaning leverage gives you a lot more risk. You're obviously buying bond-related closed-end funds that are probably intermediate to longer-term maturity. And you bought these because they were paying high distribution rates. Distribution is not your yield. You could be getting paid back principal in addition to the yield. That's the distribution. If you were down 12% in 2013, the reason is simple. Interest rates are slowly moving up because the economy is getting better. If the economy continues to get stronger, which we anticipate, and rates just slowly move up, you could lose a lot more than the 12% you already lost. I would seriously suggest you call our office either in Naples or in Fort Myers, where we have the number on the bottom of the screen. Make an appointment. I can tell you from the calls we're getting in the last 6 months, we have had a number of new clients hire us. They came from the brokerage houses that falsely believed they had an advisory account. They were sold a lot of bond and bond funds and closed-end funds for income, and they're losing their shirt. Closed-end mutual funds have a substantial amount of risk, especially if they're leveraged and they're trading substantial over NAV. Call our office. We'd love to help you. Dennis in New York. Love your show. What is our outlook for the stock market? Dennis, thanks for the nice comment. We always appreciate your comments. By the way, go to reznywealth.com. You can go there, sign up for not only our newsletter, but you can also download some of our free reports. One of our reports that is extremely popular is called How to Avoid Outliving Your Money During Retirement. It's a must-read for anybody who is a pre-retiree or retire. Our other report, by the way, is the one entitled Fiduciary versus Suitability. Back to your question, though. The stock market outlook. You got to remember, the stock market is not just the U.S., and this is the crux of the problem for most investors. They only look at the U.S., and generally speaking, they only look at the S&P or large cap stocks in the U.S. What we do at our firm is we look at all the different stock markets, the bond markets, commodities, gold, all different asset categories. At our firm, we don't look at lopsided or one-sided. We look at all the areas. I can tell you, generally speaking, and again, this may change over time, relatively stronger has been last year and continues this year to be small and mid-cap stocks in the U.S. Our primary emphasis, because we run a strict strategy off relative strength, our higher allocation currently is into those stronger, relatively stronger areas of small and mid-cap. Now, our positions can't change at any time. We do have some helpings currently in some of the emerging market. Again, those positions can change, but we want to be in the areas that are relatively stronger and in an uptrend and have a better growth potential. Those areas have a tendency to have an opportunity to outperform, and we currently still like the small and mid-cap, more so in the U.S., but what we could see is a big resurgence down the road in some of the emerging market economies. Tony in Fort Myers, Florida. Our advisor is recommending a Pacific Life Value Select variable annuity for our 401k rollover. What is your thought? Simple. Don't buy it. Annuities are sold. Anybody selling either an equity index annuity or these hybrid annuities or a variable annuity is working on commission. They're working under suitability, Tony, and they're not working in your best interest. They're basically trying to sell you an expensive annuity that's going to line their pocket and their firm's more than you. Do not buy an annuity, and never ever put an IRA or a Roth account in an annuity. That's a disaster. First off, the average annuity that we review, and by the way, that annuity that you specified, I've reviewed that, and I've had many clients hire my firm that were sold that and didn't understand what they were buying. That particular annuity has expense ratios that could be well north of 3.5% to 5% every year against your return and your money. The investment options are mediocre to lousy. When you buy an annuity, you insanely lock your money up, often for 7 to 9 years to get all your money. And if you want it, you got to pay a big stiff surrender until that penalty is gone. At the end of the day, annuities are sold by brokers and so-called advisors who care about lining their pockets. They're expensive, the investments are mediocre, and when you buy one of these, you still have to decide how you're going to invest in what sub-accounts. The broker's responsibility is not to manage your money. It is on your shoulders. Don't buy it. Fire that guy. I'd love to have you call our firm. We'd love to help you with your 401k plan rollover. If you want a firm that's a fee-only money management firm whose only interest is there to help you grow and protect your retirement, call our office number or visit my website at the bottom of the screen, ReznyWealth.com. I'm going to take a short break coming up. I'm going to come back with more questions and more of your concerns after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. Hello everybody, we're back. You're listening to us live today. This is the Rezny Wealth Report. I am Brian Rezny, president of Rezny Wealth Management. Rezny Wealth Management is a fee-only registered investment advisory firm or a money management firm. If you are concerned about the advice you're getting, if you're realizing the advice you're getting is less than advice and your money is not actually being managed, it doesn't hurt to talk and get a second opinion. Call my firm for a consultation or visit my website at ReznyWealth.com. We've got some great information, some free reports you can download. You can go there, sign up for a consultation, or if you'd like, you can call the number at the bottom of your screen. That's our office number. Call it, make an appointment. As I said before, it doesn't hurt to talk and get a second opinion. Marilyn in Fort Myers, Florida. I've been to one other retirement specialist with a local company, but I'm afraid to turn my money over to him because I fear any variable annuity. What do you think? First off, Marilyn, the person that you saw, if he's trying to or she's trying to sell you an annuity, they're not a retirement specialist. That's a bogus title a lot of these salespeople use in order for you to think they know more about retirement than they do. The bottom line is this: the SEC and FINRA have sent out reports and warnings to seniors and investors about bogus titles that often people that sell annuities or investment products use. Your person is not a retirement specialist. If he's trying to sell you or she's trying to sell you a variable annuity, they are basically a salesman or a broker of investment products. That person's working under suitability. He does not have a legal obligation to work in your best interest. He's more worried about lining his pockets, selling you an expensive annuity that doesn't belong in your retirement account. So what I would suggest, never ever, like one of my previous callers, ever buy an annuity, whether variable or equity index. These things are horrifically bad, they're poor performers, and they're riddled with fees, and you insanely lock your money up with big penalties to get it all out. That's ridiculous. If you'd like, call our office for a consultation. I'd love to talk to you. We actually understand retirement. More importantly, we work as a fee-only fiduciary money management firm, which is exactly what you need to help grow and protect your retirement. Lisa in Naples, Florida. I have approximately $1.5 million. I own the PIMCO Total Return Fund, PTTAX, approximately $700,000. My advisor keeps telling me to hang on. What do you think? Well, Lisa, if you keep taking the advice from, again, it sounds like your broker, you're going to basically be stuck in this PIMCO Total Return Fund, which last year lost money. Wow, that's a shocker. The reason your broker wants to keep you in that fund is simple. He gets a trailing commission as long as you keep it in there. The PIMCO Total Return Fund, managed by Bill Gross, is one of the largest bond funds in the world. That doesn't mean it's the best. In fact, there's many other bond funds that are substantially better and have performed better than the PIMCO Total Return Fund. But that's not the point. The point is, that fund did well in the past when interest rates were coming down. Remember, bond values go up, or bond mutual funds typically will go up when rates are coming down. Well, as we hit the bottom back in June, July of 2013 of interest rates are moving up. The more rates move up, the more you will lose on that PIMCO Total Return Fund or have a chance to lose. That fund is not appropriate in today's interest rate sensitive environment on the way up. Ben Bernanke told you they're going to stop quantitative easing or reduce it. The economy is getting better. Rates are slowly moving up, not only for you, but for all of our TV listeners. If you own bonds, if you own bond funds or income-oriented investments, these are subject to a lot of disaster pain as rates move up. You need to get out of that PIMCO Total Return Fund. I don't know how the other portions of your money is managed or where it's put, but that fund, to me, it's not appropriate. You really need to look at all your positions and make sure you actually are running a strategy. You clearly do not have a sell strategy. You've got a broker keeping you in what is not appropriate anymore. Carl in Cape Coral, Florida. I own 450 shares of Groupon, symbol GRPN. I bought it after the IPO approximately 3 years ago. It's down big. Would you keep it or sell it? Carl, dump that thing fast and take your tax loss. One of my recommendations I always give, not only on my radio show, but also on my TV show, never ever buy an IPO. IPO stands for Initial Public Offering. Never buy one of these. You always want to wait a year after they've IPO'd, wait a year so you get some financial data and see how they kind of act and trade in the market. If it's going to be the next super-duper investment, you will have plenty of time to buy it after research, after you've watched how it's traded. Remember, these firms that are investment banking firms, all these big Wall Street firms you hear about all the time on TV, they get sued and fined by SEC and FINRA. Their job is to basically do a lot of this investment banking or IPO companies like Groupon. When they do that, they work for Groupon. They then call you, the client, and offload that stock to you. So don't believe the advice from your broker when they call you about these IPOs. Avoid IPOs, wait a year, do your own research. Your broker is doing little or none. Their job is to sell you an IPO. Your job is to make a return and protect your retirement. Again, make sure you understand where the advice is coming. Sell Groupon. takes your tax loss. That company's been lousy. The margins are slim. They're losing money. I don't like it. Arnold at Fort Myers, Florida. What do you think about buying gold? It's dropped a lot. Arnold, yes, gold has dropped a lot, and it can drop a lot more. We run a strict strategy at Rezny Wealth Management off relative strength. We basically take all asset categories, not just stocks, not just bonds, not just gold, but look around the world at all classes of assets. We then rank those on relative strength or performance. We own the top sectors, and we basically sell the ones that are becoming weaker. Gold is at the bottom or close to the bottom of our ranking system. So that means there's 30, 40 asset categories much higher in the ranking system. You don't buy weakness, you buy things that are coming back and getting strong. Gold made new lows last year in 2013. I'll give you a little information. Back in 2012, well over a year ago, we actually owned some gold in our portfolio because gold was relatively strong going into December of 2012, a year ago. As it fell out of favor a little bit, it started getting weak and it fell out of our top ranking system. We sold gold in December 28th of 2012 and we replaced it with IJH, or the iShares 400 mid-cap. Gold continued to get weaker and weaker and weaker throughout 2013. It dropped 26%. Now, do we know gold was going to drop 26%? No. But what we do is we run a systematic strategy and sell assets that are starting to get weak, and gold has gotten weaker and weaker and weaker. Gold is still in a negative trend. It's still in a downtrend. It's still weak against many other asset categories. Just because something's dropped a lot doesn't mean it can't drop another 26% this year. Lou in Naples, Florida. I have 3 IRA accounts with Wells Fargo, approximately $150,000 each. My advisor has me in 65 stocks, 14 mutual funds, 1 variable annuity. This seems spread all over and has done poorly. What am I missing? Is he fee only? Lou, great question. First off, I'll answer the last one first. Wells Fargo is a broker-dealer. By definition, broker-dealers sell product and they charge commission. So any firm that has any form of compensation other than a management fee is not fee only. So I don't care if you're at Wells Fargo, Morgan Stanley, or any of the other firms. None of these big brokerage firms are fee only because they're a broker-dealer. So they can never be fee only. So that's number one. Number two, you have a variable annuity you were sold. A variable annuity is a commission-based product through a broker. So that means, again, that person would not be fee only. The other thing, you've got 65 stocks and 14 mutual funds. You are way spread all over. What is the investment strategy? I would ask your advisor to hand you a copy of the investment strategy and how he's managing your money. You'll probably be shocked that he'll probably tell you, hey, you're in a brokerage account, not in an advisory account. If that's the case, you are on your own. Having 14 mutual funds in one account, that makes 0 sense. 65 stocks? Who's managing those stocks? It sounds to me like you've accumulated assets over time. Is there an investment strategy? Ask that firm. What I would suggest you do is go to my website, reznywealth.com. For free, you can download our fiduciary versus suitability questionnaire. Download it. Take it to that advisor. Ask him those 13 questions. You will find out real quick if you're in a managed account, if they're fee only, what conflicts they have, and what it's really costing you to utilize one of these Wall Street firms. So I suggest you do it. Go to reznywealth.com, fiduciary versus suitability. Then call my office, make an appointment. I'd be more than happy to sit down with you personally and help you straighten out your portfolio and show you the difference between managed money and brokerage. Asset allocation, the failed pie. I bring this chart up for one reason. I see this a lot when people come into our office. Our last caller, he's got the big giant pie. It's spread all over. When you get to a certain point and you have too many assets in your portfolio, all you're doing is you're watering down the good stuff with the lousy stuff. Wall Street likes to do what's called asset gathering. They basically put you in these pie asset allocations. They spread your money all over the place. So you have some investments that are appropriate and you have a lot of investments that are not appropriate. The non-appropriate ones that are going down drag down the good stuff, so your return ends up being often lousy, or you take on more risk. I always tell investors, own what's relatively strong. Sell as assets are getting weak. Don't spread your money all over the board and in the failed asset allocation pie that a lot of these firms push on their clients. Ask yourself this simple question: how did your asset allocation work last year? Larry in Fort Myers, Florida, our advisor is recommending a variable annuity and a non-publicly traded REIT for our 401k rollover. I'm Larry after listening to your show. What do you think, and will your firm handle an account of $650,000? Yes, Larry, we do handle accounts as low as $500,000 on up. Occasionally, we will take a smaller account if you're a nice person to do business with. So we are a little flexible there. Bottom line is this: you're clearly working with a broker. Never ever buy a non-publicly traded REIT. These things are toxic, they're expensive, don't buy it. When you buy a non-publicly traded REIT, they often have up to an 18% haircut between commissions and underwriting fees that go to the firm and the broker. That takes away from your portfolio. Putting your money into a variable annuity from a 401k plan, again, expensive, mediocre, don't do it. You're clearly working with a broker and brokerage firm. Anybody who sells non-publicly traded REITs and variable annuities is working under suitability, and they're trying to sell you what's better for their pocket and their retirement. You should care about your retirement. Again, I would suggest you call our firm. We can help you and handle your account in a proper manner. Complex products don't belong in your portfolio. Folks, I'm going to put a list up of what you do not want to buy or be sold. Variable annuities, mutual funds, A, B, and C class share, structured products, non-publicly traded REITs, fixed equity index annuities, and managed futures. None of these belong in your portfolio. These are all highly complex investments manufactured by insurance companies in Wall Street. They're sold to investors who don't understand them. These things are often riddled with fees, often lock your money up with a lack of liquidity. Those are the investments on my hit list to avoid. Check your brokerage statement. If any of those show up in your account, you're definitely working under suitability, and that firm's interest is their interest. Unfortunately, it's not yours. Folks, I'm just about out of time. Please visit my website, reznywealth.com. If you'd like more information about my firm, if you'd like to schedule a consultation, I always tell investors, if you're not happy with what's going on in your portfolio, you're concerned about your money, call us. Our phone number's on the bottom of the screen, or visit our website. I'll see you next week.